I think that what we're going to see is a continued optimistic approach from markets in general, fundamentally because the fiscal policy added to central bank action will continue to drive multiple expansion in equities and can maintain bond yields relatively low. But we have to be aware that once the optimism about expectation gets to the point of seeing nominal GDP growth converging to inflation rates, then we see that the excessive optimism, particularly on the more cyclical side of the economy, is likely to fade out. I think that will be the base effect plus fiscal policy plus central bank action. All of those things support markets into, I would say, April, May, beginning or end of the first half. But then what we start to see is the reverse effect of the base effect. We will start to see inflation coming down. We will start to see macroeconomic data being a little bit less let's say, optimistic or positively surprising. And that's where we have to be, therefore, reducing exposure, in my opinion, to the more cyclically exposed assets in the market.
But let me raise you a reverse base effect here, because what we've seen on the challenging earnings is actually multiples become more stretched as obviously the price has gone up in markets. You've got the P and you've got the E, and at the moment the markets are more interested in the P than they are in the E. When we get through this reflation, the E hopefully will have improved. At that point then, will valuations look less stretched and actually people become more interested in owning cyclicals because they're demonstrating that they can grow in a reflationary environment?
Well, I don't think it will happen that way. I think obviously the E part of the equation will improve. However, the long-term challenges that have affected cyclicals remain. High levels of debt, technology, the change in the consumption patterns because of aging of the population in developed economies, and the concepts of overcapacity that we have seen rising, particularly with the rise of zombie companies. All of those things make the economic cycles shorter, but also more abrupt. Therefore, yes, there might be an improvement, but the improvement is not enough to justify the valuations on companies that continue to generate, let's not forget that, returns below their weighted average cost of capital, even in a recovery.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.